Hello and good evening. My name is Ankit Sharma. I am a PhD scholar at Gujarat University and I am doing research on non-performing assets. It is an interdisciplinary research which combines the disciplines of economics and finance. And I am going to be a faculty for this demo session, which is about cost accounting and management accounting. And in cost accounting and accounting, today we will be looking at a smaller aspect of it, which is the marginal costing. We'll be looking briefly into what marginal costing is, and we will be looking briefly at the features of marginal costing or two very basic different types of costs, that is the fixed cost and the variable cost, and we will understand what is marginal cost, and then we will understand what is marginal costing. Right, so this is just a demo session for collegedekho.com, and since this is a demo session, we will not be going into much details about marginal costing, but we'll be giving you a brief idea about how these classes, how these demo sessions are being conducted, and how the full range of classes, which are about 1 hour for one session, and which gives you a complete understanding of different types of subjects, how those classes would be conducted, right? So now let us begin with our topic for today, which is marginal costing. So first of all, let us understand what categorization of expenses is, right? If you have the previous sessions that we have been conducting about cost accounting and management accounting, we have already covered a few basic aspects of costing and management costing, what these topics are. But again, first of all, whenever this term cost that comes to your mind, what does this term cost mean, right? What is this expense that is categorized in different types of categories, such as fixed cost or variable cost? What are these costs? Right? So cost is the expenditure that a company or that a business incurs for the raw materials that it purchases or for the services that it consumes in order to arrive at the final product of the business, right? And in order to arrive at the final service that the business has to offer, that the company has to offer. So whatever service or whatever good that is used in the production of the final product or in making the final service ready for use by the customer is your cost. Any expenditure that is incurred in the production stages, right? In the development stages is your cost. All right, now this cost could be of two types. Now, what are these two types of costs? That is the fixed cost or the variable cost, right? Or the fixed expenses and the variable expenses. Now, how is the categorization between fixed and variable done? Now, let us understand that. So, fixed, as the name suggests, it is a fixed type of expense. It is a fixed type of cost, which remains the same irrespective of how the economy is, irrespective of how your production is, irrespective of whether you're producing 1 unit of product or either you're producing, let us say, 1 lakh amount of 1 lakh number of goods, right? So it does not. That is why, as the name suggests, these are fixed expenses, right? Now, a few examples could be your rent, the rent that a business or a company is paying for the industry that business is holding, or for the office that the business has, that the company has. So whatever situations that are going on, whether outside the business or whether in the business, it does not matter because the rent is always and always going to be the same, right? So this was an example of fixed expenses. Now, let us understand what variable expenses are. So again, as the name suggests, variable, right? These expenses vary on the basis of how much product is being produced, right? So let us say that today, if you are uh, producing 1 unit of product, and the cost of procuring the raw material for this product is 10 rupees, right? So tomorrow, let us say that you change your decision, and tomorrow you are going to produce 100 rupees of 100 goods, 100 amount of goods, 100 number of your final product, right? So, but the cost of procuring the raw material for one product, for one quantity of product is 10 rupees. And if you have decided to produce 10 quantity of goods, then your procurement cost of raw material would be 1000 rupees, right? But earlier on, yesterday, it was just 10 rupees because earlier you were just producing 1 unit and the cost of procuring raw material for 1 unit is 10 rupees. But today you have changed your decision and today you are producing 100 units, and now accordingly 10 rupees per unit multiplied by 100 units, your final procurement cost of raw material would be 1000 rupees. So this cost of production, this cost of raw material, it is varying, right? It is not fixed. It is changing, and it is changing on the basis of how much product is being produced, right? It is changing on the basis of the factors that are involved in the cost of the raw material, in the cost of production, right? So that is why, as the name suggests, these are variable expenses, these are variable costs. Now, what was the need for understanding these different types of categories of expenses? So first of all, these are very basic concepts of cost. Everyone should know this. But secondly, whenever we are talking about marginal cost, whenever we are talking about marginal cost in the process of accounting for these costs, different types of costs, out of whatever the marginal cost amount is, this marginal cost amount is broken into two parts. The first part represents the fixed expenses, and the second part represents the variable expenses, right? So let us say that we will understand this in little detail later on. But for now, let us say that the marginal cost for a company to produce 1 unit is 100 rupees, right? Now, this 100 rupees, while accounting for this cost in the books of accounts, while analyzing this marginal cost, this 100 rupees of amount will be divided into two parts, the fixed cost part and the variable cost part. In order to understand what is the fixed, if I produce one more unit, what is the amount of fixed cost that I will have to pay on this product, and what is the amount of variable cost that I will have to pay on this product. And accordingly, the business, the management, the company makes decisions and makes strategies and makes plans about how much amount of product has to be produced and how much amount of raw material has to be procured. Because after a certain period of time, after a certain amount of goods that have been produced, the fixed expenses become constant, right? Because let us say that you have to pay 10,000 rupees of rent in the example that we used earlier. So this 10,000 amount of rent would remain the same always, right? Whether you produce just 10 products, whether you produce 100 products, whether you produce 10,000 products, right? And whether you produce 50,000 products, this is going to be the same. So this amount that is divided among every product that is produced, it will keep on becoming less and less and less, lesser and lesser, lesser and lesser. So if you're producing 100 units for rent, every product will be allotted an amount of 10 rupees, right? But if you're producing 1000 products, uh, I'm sorry, if you're producing 100 products, then every product will be allotted an amount of 100 rupees. But if you're producing, let us say, 10,000 units, then every unit will be allotted for the rent portion, every unit will be allotted just 1 rupee, right? Because the amount of units are increasing, right? So this allocation is done between fixed expenses and variable expenses in order to understand after how much amount of goods, after how much units of goods that should be produced, would the fixed expense become constant after a point that the expenses that are allotted to a particular unit would become cheaper and cheaper, lesser and lesser, lesser and lesser. Because the variable expense per unit will always remain the same, right? While the fixed expenses per unit will always be variable, right? They will never be constant. Just like we understood in our previous example that the rent in the wholesome amount of rent, which is 10,000, which was 10,000 in our example, this wholesome amount of rent would always remain the constant, but the per unit amount of fixed cost, the amount of fixed cost that is allotted to per unit of the goods produced will always not be constant, right? It will always vary. While on the other hand, the variable expenses, overall, the wholesome amount of variable expenses will never be constant because it depends on the number of units that are being produced. While on the other hand, variable expense per unit will always be constant because just like this example that we used in the beginning of this topic, that let us say that the cost of procuring of raw materials for one unit is 10 rupees, then and if only one unit is being produced, then the cost of raw materials is 10 rupees. But tomorrow, if you change your decision and if you say that you have to produce 100 units instead of 10 units, now your cost of procurement of raw material would be 1000 rupees, right? So this overall amount of variable expenses is ever changing. It is never constant. But the variable expense per unit, which is 10 rupees, it always stays constant. All right. Now, in this slide, we have understood that the expenses could be categorized into basic ways, that are the fixed expenses, the fixed cost, or the variable expenses and the fixed cost and the variable cost. And we also understood that whatever the marginal cost amount of one unit that is computed, it is divided into portions, one portion for fixed cost and one portion for variable cost in order to understand how much amount of fixed cost or variable cost would be there if a business produces just one more amount, just one more unit of the final product, right? Now let us look at the margin. Let us look at the for these different types of costs in the books of accounts of a particular business. Then marginal costing is the change in the total cost when the quantity is increased by one NOS or one unit. Now, what does this mean? To understand this, let us first look at this term marginal or margin, right? Now, what does this term margin mean? So, margin basically means difference between two specific items, right? And so, let us say in if a business is producing 100 units today, and if the business is producing 101 units today, so the margin that exists between the production cost of 100 units and 100 units would be computed using the process of marginal costing, using the technique, using the costing technique of marginal costing. Right? So margin, as the name suggests, it is a margin between two different items. Marginal costing is always the change in the total cost when the quantity is increased by one loss or one unit. Right? Now the marginal costing is also the cost of producing one more unit of good. Right? So in the same example that we have used, that today if you are producing 100 units and of to fixed cost, and how much of this change is allotted to variable cost. All right. Now let us understand the definition of marginal costing. So marginal costing is a costing technique. We have understood this, wherein the costing technique, that is variable cost, right, is charged to units of cost, while the fixed cost for the period completely is completed. Uh, right. I'm sorry, I think a word is missing here. So marginal costing is a costing technique where the costing technique, that is the variable cost, is charged to the units of cost. We have understood this basic differentiation between variable cost and variable cost and fixed cost. That fixed cost overall remains constant, but per unit it is always changeable. It is always it always varies depending on the amount of units, on the number of units that are being produced. But on the other hand, variable cost per unit is all variable cost on the whole. The whole sum amount is always and always changing. It is never the constant, right? So the fixed cost for the period is completely written off against the contribution. What is the contribution? Contribution is the total sales revenue minus the fixed cost, minus the variable cost that gives you the contribution. And from this contribution part, you deduct the fixed cost. We will discuss these formulas or discuss these techniques of computing the contribution and how it is calculated later on in detail when we are looking into 1 hour sessions of these topics, when we are looking into 1 hour sessions of these different types of techniques of costing, and when we will be studying marginal costing and cost accounting in detail, right? So for now, marginal costing, in marginal costing, the variable cost that is being charged to every unit of product is computed, and it is seen that out of the change that is coming to the total cost of production when I'm producing just one more amount of unit. Uh, this out of this change in the cost, what is the amount of change that is arising out of fixed cost, and what is the amount of change that is arising out of variable cost, right? Now let us look at this example. So for a business, if the variable cost is 25 rupees, right? So the variable cost per unit here is 25 rupees, then the fixed cost, which overall remains the same, is 1 lakh rupees. Now, what would the cost of producing 10,000 units? So if the variable cost per unit is, and the cost of 10,000 units would be 25 multiplied by 10,000 units, which would be 2 lakh 50 rupees. So this is the cost of producing 10,000 units. While the fixed cost, as we discussed, that the wholesome amount will always remain the same. So the total cost of 10,000 units would be fixed cost plus variable cost. So the total cost of production would always include these two amounts, the fixed cost amount and the variable cost amount. So here, the fixed cost is 1 lakh rupees and variable cost is 2 lakh 50 rupees. So a combination and aggregate of these two different types of costs, which is 1 lakh and 2 lakh 50 rupees, would tell you the total cost of production for that business to produce 10,000 units, right? So putting in these values, we get 1 lakh rupees plus 2 lakh 50, which is 3 lakh 50 rupees. So 3 lakh 50 rupees would be the cost for the business to produce 10,000 units. Now, let us understand that if these total units are increased by just one unit, all right, we are not increasing 100 units or 200 units, just one unit, all right. So the total cost of producing 10,000 in one unit would be 1 lakh rupees, which is the fixed cost. As we discussed, that the wholesome amount would always remain the same, but the variable cost, which is per unit, which depends on per unit, and we also discussed that the variable cost per unit would always be the same. So the variable cost for producing one more unit would be added as well, and the variable cost for producing 10,000 in one unit would be 2,50,025 rupees, right? So again, the total cost would be 3,50,025 rupees. And again, if you have to compute the marginal cost, as we discussed that it is the difference of margin between two specific items, and here marginal cost always tells you the change in the production cost, the change in the production cost of all the units, that the change in the cost that a business incurs when just one more unit of item, just one more unit of the final good is produced. So here, earlier we were producing 10,000 units, and now we are producing 10,001 units. So just one unit is being produced more, and the marginal cost of producing just one more unit of this product would be 3,50,025 minus 3,50,000, which was the earlier cost. So the marginal cost here is 25 rupees. All right. And now, where is this cost arising from? Where is this marginal cost of 25 rupees is arising from? Is it coming from the fixed cost, or is it coming from the variable cost? Now, in this example, in this particular example, we know that this cost is coming from the variable cost per unit, because there are already a fixed amount, there are already a huge amount of units that are being produced in, and because of this, the fixed cost is already reimbursed, right? This amount of 1 lakh rupees is already earned by the business, right? That is why it is no longer a part of the change in the total cost of the company. So in this particular example, this marginal cost of 25 rupees is arising from the variable cost of unit. All right. Now let us look at the features of marginal costing. Again, we'll be looking at a few of these features. We'll be understanding them briefly. We'll just be going over them. So there are various features of marginal costing. It is used in different types of ways, but some of them could be like marginal costing is used to know the impact of variable cost on the volume of production or output. So how much variable cost is there in the business per unit, and what is the impact of this variable cost on the total output, on the total amount of units that are being produced, right? That is understood from marginal costing, as we just saw in the previous example. Then marginal costing could also be used in the break-even analysis, that is an integral part or an important part of marginal costing. Now, what is break-even analysis? Again, this is a pretty lengthy concept, but again, just to give you a brief understanding of this. So break-even analysis, this break-even point is a point in the costing, is a point in the earnings of a business when the revenue that is generated by the company is exactly equal to the cost of that company, right? When it is exactly equal to the cost of raw materials or the cost of services that the company is incurring, that the company is using on the production of these different goods and different services, right? So at this break-even point, there is no profit, there is no loss. All right. So up until this break-even point, whatever the fixed cost is divided among these units equally. But after this break-even point, the fixed cost is reimbursed, right? It is earned by the business. So in every revenue, that is every cost, whatever the change in the cost that is there in the total cost of the business would mostly and would always be arising out of this variable cost, right, which is changing on the basis of the total amount of units that are being produced. All right. Now, marginal costing also contributes, it tells you the contribution of each product or department uh, in the profitability of the business, right? The contribution of each product or a department. So it could be done department wise as well, as in the production value of each department. All right. Then marginal costing, another feature could be that addition of variable cost and profit to contribution is equal to selling price. It is the formula, it is a general formula to calculate contribution from the total revenues. That is, out of the total revenues, the total revenue that a business has generated. And from this amount, if you deduct the variable cost, whatever the resulting amount is the contribution, which is also the profit of the company, right? So if you add the variable cost and this contribution part or the profit part, what you will get would be the selling price per unit, right? Because you would know the total revenues, and this total revenue could be divided by the total amount of units that are being produced. All right. So these are just a few of these features for marginal costing. And in this topic, until now, we have looked at the meaning of marginal costing, what does costing means, and we understood that whatever the marginal costing for producing one more additional unit of product is allocated to either fixed cost or variable cost. And we understood what these different types of categories of costs are. We understood what fixed cost means, and we also understood what variable cost means. All right. And then we looked at an example that shows how marginal cost is computed. And towards the end, we looked at a few of these features of marginal cost. All right. And this is it for this topic. This is it for this introductory session, for this demo session. And this was just to give you a perspective into how these classes at College Dekho would be uh, how these classes would be uh, conducted in real life, and how these interactions will go on, and how detailed the explanations of different concepts would be. All right. So I hope you had some happy learning, and I hope to see you in these one hour sessions sometimes. All right. And this is it for this session.